Welcome to the Whitwam Wealth Real Estate Podcast. On today's episode, why multifamily wins, the smart investor's path to scalable wealth.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. And on today's podcast, our topic is why multifamily wins, the smart investor's path to scalable wealth. Today's episode, I'm going to discuss multifamily real estate. This is a powerful and scalable investment strategy. Today, we're going to cover what is multifamily investing, why many investors focus on it, the risks, and how beginners can get started. So let's start with a basic understanding. So first off, when we talk about multifamily, the definition is not very complex at all. Multifamily refers to a residential property of two or more living units. That means a duplex, a triplex, a fourplex, eightplex, and large apartment complexes. There's no limit on the size as long as it's residential. When it comes to financing multifamily, there are two distinctions. First off, in 4 units or less, when you're financing them, it's considered a residential purchase. So for instance, if you're buying with your VA benefits as somebody who's been in the military, you can buy a fourplex with 4 units or less using your VA benefits. There's lots of programs out there for these residential purchases, whether it's through Fannie or Freddie or those type of GSEs and private lenders out there. But a property with 5 units or more is considered commercial. And the reason this is significant is that all commercial multifamily is valued based on its income, not comparable sales. Where residential property is generally valued because of its comparable sales to other things in the marketplace. Now, there are some rental programs or some DSCR rental programs, those kind of things that utilize rental income for it. But for instance, if you're going VA and you're going to buy a fourplex and you're moving into one of the units, they're going to look for comparables and they're going to look for income to make sure that the rents will cover the payment and that the property is comparable in value. But you buy a 100-unit apartment complex, what they want to do is they want to know what the income is, and they're going to utilize the income for the basis of the value of the property, which is our cap rates and our return on value, those type of things, in order to determine lendability. And this is where significant benefits begin. So why do many investors focus on multifamily? There's some great advantage in the multifamily sector. First would be economies of scale. You certainly are growing bigger, faster on the acquisition of one property than you would on one single family property, right? And then managing one 20-unit complex is often easier and cheaper per unit than managing 10 single family homes. You have one management team, one set of expenses, and one structure to worry about or to think about or to deal with. The expenses scale more efficiently. Second would be stronger cash flow. With multiple units producing income, multifamily properties tend to deliver more consistent cash flow. Okay, I want you to think about this. If one tenant leaves a single family property, your income on that property drops to 0. In a 20-unit building, the loss of one tenant is of small impact, right? The third great thing here is market appreciation. This can be a big deal. The value in multifamily properties is what we call the net operating income. It's the amount of money that this property is throwing off every month in net income, the money you get to keep. Generally, in multifamily, the leases are structured with rent escalations already built in. Now, you can do this on the single family side, but I'll tell you, as a real estate broker and the leases that I see across on the single family side, it's not often that we see rent escalation clauses built in. On the commercial side, We see it all the time in the templates that are used. So you get increased income, improving your net operating income on a property on an annualized basis. There's also reduced expenses. You can spread them across more tenants. The property becomes worth more and shields against market conditions better. Your appreciation is in the rents, not in comparable sales. So if you can keep rents strong, then it's not as big an issue as what other properties have sold for. And typically, you can keep rents strong by keeping your properties in good shape. It's one of the things that I learned, the slumlord mentality typically is not going to have escalating rates due to the demand for the property. It's just going to simply be inflationary factors. But if you get your property in good shape, a lot of times you're able to keep top rents and escalate them at a higher level because people don't want to move. Your tenants create your appreciation. And fourth would be financing options. Once you get to the 5 units or more, you unlock things like agency loans backed by Fannie and Freddie Mae. No longer based on the same characteristics as the single-family residential loan. You get longer amortizations, non-recourse debt in many cases. So if something happens, the property is securing it, not you and your finances and your incomes. That means less personal risk, more leverage and growth. Third would be, the third thing we want to talk about, is the risks. So it can't be all, sunshine and showers. There are some risks with multifamily. Now, let's be real. Multifamily is powerful. But again, anytime you're dealing with larger, you're going to increase the risk because the reward can be greater. First, they come with higher purchase price, right? Maybe you go out and buy a single family residence in a certain area and wherever you're at in the country, $100,000. $200,000. Where I'm at, $500,000. Some other places, $1 million, right? But you go out and buy a multifamily, you may be talking $1 million, $5 million, $10 million, $20 million. So they are a higher purchase price. So since they cost more, there's more upfront costs, larger down payments, larger capital requirements. And so that can create some risk for people who are, hard on the leverage side. Now, there are things you can do. I mean, in the commercial side or in the higher end or the bigger multifamily, I know guys who bought them for zero money down and they've leveraged them and they work some of the same principles you find in the book, No Money Down, that I wrote. And they leverage those on larger scale properties. So, you can eliminate some of that. But in general, there's larger upfronts and down payments. Second, multifamily, property management matters more. Bad property management can absolutely destroy a multifamily deal pretty quickly. Tenant issues, maintenance delays, poor bookkeeping. It all compounds at scale. A friend of mine just a few months ago told me a story about one of his projects where he had this very issue. It was just one of his favorite large luxury apartment complexes, and he had turned it over to a manager and a management team. And the reports they were getting is that everything was good, everything was going, and they kept needing a little bit more here, a little bit more there, and the expenses started to grow, and the vacancy started to increase. And so one day he and his wife went and actually traveled to go look at the property just to do boots on the ground to see what was going on. And he saw this property that had been an absolute gem, as far as the aesthetics, the way it looked, the condition of everything in the property he had seen, that trash wasn't being removed, the garbage areas were filthy, the parking lots were dirty, things were in disrepair. The place, though the reports they were getting painted a different picture, the place was really in disarray. And so he had to make some hard decisions about the management team. But the issues were bigger by that time because now they had to put more money back into it to bring this thing up to the aesthetic that he wanted, to reach the clientele that he wanted, so that he could reach the vacancy rate that he had budgeted for on this property. And when I heard him tell the story about it, you could see for him this was a property that was pretty well invested in. He actually developed the property himself. You could hear the pain in not just the money, but in the whole process of seeing one of his large, very valuable properties being managed incorrectly. So that does become a risk, right? So the other thing you have the concern for in this area of multifamily is market sensitivity. Multifamily can be sensitive to employment trends. For instance, if you're in a city that has one manufacturing sector, what do you do if that manufacturing sector closes down or moves? Now, I can tell you that 4 years previous to when I'm doing this podcast, that was a real risk. There were a lot of communities that had lost manufacturing. I was talking with an investor from the UK, and he's got a property in a community that it was based solely on manufacturing. He's got this great development project, but really the development project now doesn't make sense with where the economy is with the loss of manufacturing. Why? Because the employment disappeared in the area. The other things it's subject to is property taxes and increased insurance rate. So it's sensitive to all of these things. And like all investing, we must understand the local market, and we have to understand the numbers. You got to understand the political climate. I mean, there's places where, rent control can kill a multifamily investment for you and cap your ability to escalate rents and to be able to move with the cost of ownership. And so these are all things you have to take into consideration. All right, here's my fourth thing. It's about how can beginners get started in this? Because for a lot of investors, it seems far off. It seems like this is something that I just could never get to or be involved in. And I know, because I remember, 30 some years ago, being in that same place. And I would say number one is education. You've got to get yourself educated. This podcast is just about cracking the ice, trying to make a little dent in it to get you a little bit of information. But I recommend that you seek out some investing groups and get to know some multifamily investors. Get to know people who are investing in this sector. You'd be surprised what you can glean from them in a 2 to 5 minute conversation at a networking group. Most of them are very willing, if they're at that networking group, they're very willing to share some of the tips and tricks that they have learned over the years. Here's some other tips. Start off by house hacking, maybe a duplex or a fourplex to get started. What is house hacking? That's where you move into part of the multifamily complex yourself. Yeah, you don't have a management team, but now you're learning the process, right? And you're getting started. And then at some point, you're going to maybe escalate this and move out of that, but you'll have had great experience and you'll now have the appreciation and equity in the property. Just live in one of the units and rent the others out. Especially with 4 and under, because they qualify for residential financing. It's a great way to get started. You can also partner with an experienced investor who they may bring some capital and skills to the investment, and you bring in capital and hard work, and you can make a deal work. And, investors are oftentimes looking for great opportunities, and then they'd like it if they can, some of them are into mentoring. So you find an investor who's looking to mentor, and if the deal makes sense, maybe this is a way you get some of your experience. You may not own the whole thing. Maybe you only own 5 or 10% of the investment, but you're investing sweat equity. You're investing your time to help make the deal work. You can also invest, passively in a syndication where you learn while you're earning. So you invest in a project that maybe is building, an 8-plex or, maybe a 20-unit apartment complex, and you're investing in it as part of the syndication, and you're sitting through the meetings, the design meetings and build meetings, getting involved as much as the syndicate will let you get involved. And you need to continue to educate yourself relentlessly. Never stop educating yourself. There are lots of avenues in today's environment. I mean, look at where you're gaining the information from this podcast today. There are lots of other places where you can get information, and learn about, underwriting, learn about markets, learn about management, learn about how to deal with these investments, and get to know, because the more that you know, the more you will reduce your risk. And really, in any investment, if we can reduce our risk, we're miles ahead. Multifamily real estate isn't just about owning apartments. It's about building scalable businesses and creating reliable income. It's leveraging appreciation and ultimately buying back your time. If you found this episode valuable, be sure to subscribe and leave us a review. Share this with another investor who could use to hear it. But that's all for this episode. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episode and related real estate investing topics. I'm glad that you're part of our growing real estate investing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.